All right, now that we've got the basic principles down on profiles, what we're going to have a look at is different day types. Now, the point of day types is to make your life ultimately very easy to piece together a story of what's been going on. As we go through next sections, we're going to look at sort of what the implication is of just the previous day, and then we're going to start building this up into a wider structure, a wider story of what's been going on. But to start with, what we want to do here is allow you to understand the implication of a certain day type and what story that itself tells you. Because this is a really important way of being able to differentiate things. Being able to say to yourself, yep, this perhaps is a move that is sustainable, this is a move that is not sustainable. So whilst we have talked about the sustainability of movement in regard to how value moves and how it's not just price that's important, we're then going to look at what a day type implies in terms of who's participating, how they're participating, what that then leads to. So what we're trying to do ultimately is use your understanding of what kind of day preceded your current day, and then how your current day is developing in order to allow you to come up with strategies that are applicable to that day. Rather than just simply trying to apply the same old strategies, what you're trying to do is say to yourself, well, this is a day that implies a certain type of movement, and this is how I can play it. So what I'm going to do throughout the course of this session is go through the standard day types. We'll get on to the more sort of nuanced or, in a way, proprietary day types that we use as well as we get into more profile-based strategy and setups. But to understand the basic day types allows you to very easily identify and differentiate between days and very quickly know what you're going to do next. So the whole point of understanding day types, it very quickly tells you a story. It will tell you whether the movement is one directional or two directional. So what I mean by that is whether, if let's say you have a move higher, this is a move that has taken the market up and constantly is pushed back on, responsive trade back, and then there's kind of a battle higher, or is it more a case that it's one directional, one side of the market, i.e. the larger time frame participants are in control of the type of participation as well gives you an idea as to who's in control. You know, for example, I'm going to look at a trend day. This is a prime example of other time frame or large time frame control, whereas a liquidation day, which we're going to discuss, is more an indication of medium-term control, which then has different implications for the next day's movement. And we'll come on to that in a moment. So you build up this pattern recognition. And one thing that I would recommend is to start off with, at the end of each day, identify each day, and then start to piece together a sequence of what typically follows a certain type of day, what typically follows a balance day, what typically follows a trend day. This way, you're shortening your recognition. You're shortening the amount of thought and the amount of preparation that goes into any day before you've very quickly come to a conclusion about what is likely. Obviously, we then need to piece together more information on that. But if you've got yourself a base case, then you can build out from there rather than trying to treat every new day as completely new and completely independent. So you're trying to differentiate day types, differentiate different days. You also, by understanding how certain days types get created, because this is the next stage of it. It's not just about being able to say, oh, that is a certain type of day. It's be able to know what the early characteristics of that are. Because if you can identify the early characteristics, you've got a very good idea of what the day is likely to look like at the end. And if you know what it's like to look like at the end, you can also have a reasonably good recognition, or at least ability to work out the path of movement that would create such a day type. We'll look more at opens and specific opening plays that are going to help with this, but by understanding what types of open typically create certain day types, you immediately know when an open play is something that has longevity, or when an open play is perhaps a short-term action and then sit back, take on new information before the next leg of any kind of movement. As we move into mapping, we'll look at cumulative story and the kind of, a way to assess the quality of movement by kind of deducting bearish information from bullish information and giving yourself almost a kind of scoring reference to go by. So what we're going to do is try and break down each different day type, key characteristics, what you need to understand, and we'll look at a few different examples of how these types of scenarios work out. Right, the first one that we're going to look at is what you call a normal day. Now, this is a term that, as with many profile terms, is perhaps not correctly used. It's not massively normal. And in terms of balance, it does not balance out in a normal type distribution. So, what are the main characteristics of this? Typically, normal days are generally more news influenced. So what this suggests is that you are going to have a day that starts off perhaps with news from the previous day. So this is news that has been received since the previous close. Day starts off with the news. What this creates is an early direction. People take that news, bullish, bearish, whatever it is, and act on it straight from the open. This then forms a large initial balance. What a large initial balance implies is that larger time frame participants have made their decision. And that's the way you've got to think about it, that if people have made their decision early, put the move in, ask yourself, well, what does that imply for the rest of the day? Because if people have done the move early, they've done all of their buying, who's left to buy? And this is why when you get these very large initial balance, normal type days, what you're going to typically get then is a drive, a limited continuation. So you end up with a profile that, if we look at the initial balance being these dark blue lines here, or the dark blue highlight here, you get very little additional trade after that. It doesn't mean to say that these aren't going to be volatile days or days that have scope of movement in them. But what it suggests to you is that the extension of movement is limited. And this is something that is often kind of mistaken, that the assumption is, well, after these large initial balance moves, you are not going to see much more. And it's not the case. The case is just more, you're not going to see new prices traded much beyond what's currently traded. We'll talk more about initial balances as we look into open plays, but what you're trying to do is also assess the size of this. Now, in order to assess the size of an initial balance, you've got to be comparing it to what you've been seeing recently and what a reasonable sized day is currently. You could use an ATR to do this. So if you're seeing an initial balance that is perhaps larger than the recent ranges that you've been seeing, that immediately jumps into large, and you can then start to very quickly infer that this could well be a normal type day. So, first characteristics, you get a large initial balance. This is generally one directional because it's news generated. The other factor is that the initial balance will typically create the high or low of the day. Now, you obviously don't know which one that is. So what you're waiting for then is the break of the initial balance. Once you have the initial balance break, you can reasonably confidently say, this is the low of the day down here. Now, this doesn't provide you a strategy or a trade, because buying the initial balance break up here gives you a very large stop, and you already know that you're unlikely to see a massively large extension. So it doesn't provide you with a strategy, but what it at least provides you is a bit more directional bias, and a bit more directional clue. What you're then looking for is more two-directional trade. The reason for this is after this large move, you're going to get responsive sellers. People who look at this and think, that's gone a long way now, this is appropriate to sell. Also, you will have the traders who buy it, reactive, the shorter time frame traders, who buy it straight from the beginning of the day and use the extension of the initial balance as a chance to take their profit. So you have this responsive nature, in this case at the highs, but also you don't get the initiative, because on the back of that very fast move early on, buyers now no longer can buy down here, and they've got to pay 50 ticks higher. Do they want to do that? And that's the important thing. This is an initial balance that puts nearly a 2% move in. So you get a 2% move in the first hour. Are people still going to be willing to pay those prices? And so you run out of buyers because they're waiting for perhaps more news. And this is what creates the two-directional trade. Buyers very quickly are going to be looking to try and buy as the market drops back down. Sellers are going to be happy to sell as you get breakouts. So in terms of basic strategy, now when I talk basic strategy, what I want to try and do is illustrate a method with which you can trade these, or at least a way of looking at it to say, these are the types of trades that are likely to be available to me, and these are the areas in which I can take these trades on. And that's the way that I'll be trying to look at this. So first strategy, of course, is going to be if you can get onto this early news generated move. This is going to be an understanding of news. This is very much a macro type trade. You're acting on that early momentum. Now, this is totally tradable. And what it's down to is recognizing that this perhaps is going to be the biggest move of the day early on because of the news. And as such, this might be where you might be willing to take more risk. You apply more risk to the trade early on. And then as the day goes on, you have an expectation that you're going to get more two-directional trade. As soon as you've had the first move and you get the break of the initial balance, you can quite quickly start looking towards strategy 2, which is more about reversal type trades, trying to play up and down the range that's established. This can be quite a volatile range. So it doesn't mean that you're not going to be given opportunity. It just means that you're not going to get opportunities that sustain. So people who are looking to try and buy as we pull back for a continuation and trying to hold a runner are likely to be disappointed on a day like this, because this is a day that naturally is highly likely to roll back to you. So it's much more about taking multiple back towards the middle type trades than it is mean reversion type trades, if you will, than it is to try and play directional continuation trades. The implication for the following day on these types of trades is that it does create a value shift. So value moves in this case up. This is suggesting the ability for continuation. What you're then looking for is movement away from value and then the market to continue in that direction. It may be a case that if this is an extremely large initial balance and range, so I'm talking a day that perhaps has an initial balance double previous ATRs, you're then in a situation where, because it has moved so far, you may well get a period of consolidation just to accept that movement in value. But on the whole, it maintains the bias in the direction of the move, or of the news move, so in this case up. Always bear in mind, if this is entirely a news generated normal day, that you can have the denial of the news, and very quickly, if you fall below the value area low, you've got the scope for the reversal all the way down. So just bear that information in mind. So let's go and have a look at a couple of different examples here. First up, this is where you can expect a normal type day, and this isn't necessarily a news version, and this is why I wanted to use this as an example. What we've got here, and some of you may have recognized this from earlier weeks, is what you would call a gap liquidation. Now, what a gap liquidation move is a move whereby participants in this range here don't get the opportunity to take the break of the range trade as many would be looking for. You know, somebody trading, so this is an hourly chart and this is then a 5-minute chart. Traders in this area are going to be looking at this for the breakout to try and play from this consolidation continuation. But they don't get the chance. You get a gap out of the range, which comes in up here, and the market then immediately runs higher. And so this is a move whereby people are getting stopped out, people are rushing to enter because the opportunity is not given to them over here. And as a result, you get this charge towards the upside. Very quickly, you can be of the opinion that this is falling into the category of large IB normal day. And as you see more of these different day types, you can start seeing how it's unlikely to be any of the others. So you're very quickly, within the first half an hour's trade, of the view this is going to be a normal day. As such, you know that you can look for pullbacks. You can start thinking, right, any kind of pullback, I can try and play continuation, and your aim is ultimately a break of the high of the day. Also, once above the high of the day, you can also look at the way the market's trading with a degree of doubt. I think that's the best way of trying to describe this. So if this is your initial balance, there's your move up. You get a pullback, and to start with, you don't get a break of the initial balance. The break of the initial balance comes here. So there's your break. You've had a deep pullback, at least half of the initial balance, and you could see where maybe you'd find some previous support coming in here. Once you get the break, this is where you get the day becomes almost confirmed. So what you're trying to do is follow a process of saying, right, this looks likely to be a normal day. When you get the break of the initial balance that falls very quickly back inside, this is now making this much, much more likely. And as a result, you can then assume that this break further higher is likely to fail. This is a fadeable break. So this is where you're able to say to yourself, right, this is a breakout that I can likely fade. Whereas for many people trying to fade a breakout, that strategy is a flawed strategy if used at the wrong time. So this is a scenario where the false break is a viable trade. It's also viable here as well. It's also a day where you expect to see trade back inside the initial balance. So this first hour of trade, you expect to see it falling back inside here. And so again, you're looking for areas of support. This, you can't call that an area of support. There's no reason that you'd want to buy here. But once you've bounced off there, that does become a support to try and play, once again, back up the range. You're treating the range that gets established later on as essentially a smaller day that you can trade up and down. So this is a scenario without any news, whereby you get the gap, the liquidation, which is that charge higher as people are forced out, and then this balancing for the rest of the day. Essentially saps the energy out of the day. Excuse me. Here we go, we're going to go and have a look at another example of this. This is a slight variation on the trade, and this is about understanding how these types of days get formed. Because what we have here from a profile perspective, this is your large initial balance, and then if you look at the extremes of the day, or out the post initial balance range, that's your range just in here. Small break to the downside, or small extension of range, and very little more. But the structure of the way this is created is different, and this is the important thing of understanding how these types of situations can get created. Because what we've had here is, rather than the move back in and then trade above, this is more a case where you get the large initial balance sell-off, followed by the bounce back, and then the seeming continuation. And this is the area where your interest is going to peak. That when you've seen this large initial balance, what you need to be thinking about, and the way to kind of try and approach this is going to need much, much more volume, much, much more pace than a normal break, because of the size of the initial balance. That's limiting it. One way I try and think about this is that if you imagine everybody who wants to sell on this day, getting that business done. So you kind of think, right, well, if this is a day that could potentially go 60 ticks, well, 40 of those ticks have been done already. How many more people are still going to be willing to sell? And that's the way that I kind of try and approach it. That, of course, there isn't a finite number of sellers on any day, but with this type of movement, you're running them out very quickly. And as such, we then break the low, and we then end up with this very choppy trade for the rest of the day. We get no continuation, and then going into the close, you get this wash back up. Where's the wash back up come to? To the extreme created post initial balance. So you get the kind of peak of the day's range established on this first pullback, very similar to that previous example, and then you're just trying to find the limit of the range to the downside as well. And that's the sort of creation of these types of days. So it's about very quickly, on the back of this type of movement, saying it's probably going to be a normal day. You get a pullback within the initial balance, so pre-break. This is where, if you get the chance to play the continuation move, that's something you can play for, with the expectation that any break of the low is going to be a chance to get out, unless this goes through with a huge increase in volume, which is not what you see in this situation. Okay, something that's perhaps slightly more normal, despite the fact it is not called a normal day, is a normal variation day. Now, this is not generally a news-generated day. This is a two-directional trading day that does early on have at least some degree of drive in it, essentially. So you get a degree of larger time frame, other time frame participation early on that does drive the market in one direction, but doesn't sustain that. Now, typically, this is going to be a result of that other time frame participant running into a counter responsive seller if it's a move higher. As such, you end up with this balance that's a little bit more structured than the normal type day. So on the whole, it will exhibit a smaller initial balance. And this then does imply that you can break this and continue further. So perhaps doubling the size of the initial balance, whereas a normal day, you wouldn't expect that. You're expecting small break of the initial balance. With the normal variation day, you're more looking for a kind of other time frame participant that's going to come in, drive the market higher beyond the initial balance, or drive it lower beyond the initial balance, but only for them to be resisted, that you end up with a responsive trade back. What this generally does is creates a day that uses the top of the initial balance as a support area. You don't expect much deviation into this zone here. That's not what you're looking for. You're expecting that trade is going to use that and create a more balancing type movement above, up in this zone. You're expecting two directional trade as well. Think of it from the point of view of the other time frame participant. If you've played the breakout and you find in somebody who's willing to sell to you, you're not going to rush to pay higher prices. You let them sell to you. You take the lower prices that you can get. And that's what the other time frame participant is going to do. That's why the initial balance becomes supportive. And that's what you will see with that two directional trade, a market that fails to drive as it gets to extremes. So, with this in mind, there's a reasonably obvious strategy that comes from this. You can use the initial balance as your support, in this case, on a move up. And you can play towards the extreme of day. So what the normal variation does do, as it begins to be created, is very quickly says to you, your bias is in X direction, in this case to the upside. So your bias is up, And you're now going to use any pullback as a chance to buy, to look for reversal patterns, to try and play back to break the high of the day. Now, the reason for looking to try and play one directionally here, despite a two-directional market, is that if the responsive trade does disappear up here, and if the initiative that initially drove us higher does come back in towards highs, you could have a situation where you get continuation. This isn't that common, and so it doesn't imply that you can't play the up from the one side and then failed break down from the other side. I think that's viable in either scenario, but the playing it towards the upside, looking more for a break to the high, give it a chance when it breaks the high to see if it can keep going. If it doesn't, you can exit the trade and look for a reversal, but it's more a case of not, say, cutting and reversing as you reach the highs there. So basic strategy is to assume that you're going to have two directional balance above the initial balance, and you can then essentially play a similar type idea to the normal day of reversion back towards the middle of range, reversion back to previous traded areas, reversion back to the IB high or back towards the high of the day. Similar implication as well to a normal day, that the value shift does maintain previous direction, and you're then looking at this more in the context of continuation, as long as this normal day, and normal day also, but normal day usually is going to break out of the current area because of the news element. Normal variation day, you're looking at this to be important directionally if it moves you away from a currently traded area. If this is a normal variation day within a wider range, the implication is slightly less. And so the continuation move loses a bit of its credibility because you are ultimately trading within a wider range. The other implication, and this all comes dependent upon what's happening. So if this normal variation day moves you out of a current range, so if you have a range traded here and the normal variation day moves you out like this, that would imply continuation. But if you've then had this previous range, normal variation, and another one, this could imply a move that is tiring because you're not driving the move on anymore. It's a kind of early push and then no willingness to keep on going. And this is kind of a slowing down. Bearing in mind that if you're seeing a directional move and still two directional trade, this is not a move where one side is really fully taking control of the move. And that's what's important about applying the overall direction to the direction of a single day. In the basic terms, it's a continuation because it shifts value, but in the wider context, compare it to where you've currently or recently been trading. Let's go have a look at a couple of examples. This is the type of idea that you can expect. So what I've done is I've taken a normal variation day profile and split it up so you can see the kind of trade within the day. And you see here, there's your initial balance, early trade out, back inside, and that creates a high just around here. Once we get another move out, so there's your first test out that fails. Once you get a second move out, then the initial balance forms a resistance, which you see there on the S and the U prints. Before, and then again, you're using this as your chance to sell for a break of the low. That's what you get. You get the break, you get a failure to continue down here, market consolidates and back up. You do, and the reason for putting this is to show that they don't all work perfectly and they don't all give you this perfect resistance at the initial balance low or the initial balance high, and you will get these deviations in. But this is a classic example of a move that drives back inside the initial balance, will tempt people to buy because they're getting sucked into the immediacy of this move rather than the totality of the information that you've gained so far. Up to this point, you could very confidently say this is going to be a normal variation day. So this is more likely to be a deviation within a normal variation day than it is to be a sudden trend change and directional move higher. This way, you can doubt this type of movement and once again look at that with the view that this is perhaps stretching a bit far, and the only place you're going to change your mind, if you can break the open and break the high, then maybe this is a change. Maybe whatever is causing this drive higher is significant enough. But until that point, based on the fact that with a normal variation day, once the initial balance is broken, the assumption is that would be the high of the day, then you can maintain that view even as it gets very close to testing it. So this is an example of a tiring type move, a normal variation day in a tiring move. We've had a trending move, that gets us up here. We've then had, there's your initial balance. So you get this drive towards the upside on the back of a marginal gap, continuation of current movement. But unlike the trend day that preceded it, after the initial balance, what you then get is responsive trade. So here's your initial balance. I've actually drawn this too high. The initial balance runs to there. So there's your initial balance high. And after that, you then get responsive trade. Rather than a market that continues to drive higher, you get a market that continually fails and falls back, culminating in a kind of trend break, even a mini head and shoulders break that brings you back to the initial balance high, which is the high of this little candle here, and use of the initial balance high as your support, again, to play back up the range. And this is a great example of a tiring move that rather than a driving move that you get from the trend, what you end up here is with this initial drive. If people try and go for the move early on and then can't continue it, they can't maintain this. On the back of such direction, you will get responsive sellers here and here, looking at, and potentially people who are already long. You've got to think about how people are going to be playing their trades here. What are other people thinking? Well, if you've been long from down here, even off the page down here, and you're suddenly getting another drive on the back of a gap, are people now going to look at this as a chance to take profit? And any spike up is a chance to sell into, as you see here and here. So this can be a little bit more expected. And on the back of that normal variation day, you then get a very balanced day the following day, which really does indicate that this is a tiring move. So this is one of those examples of the normal variation day not necessarily being as bullish as it might on first thoughts. Look, if you took this day alone, then open down here, value shift higher, this is a bullish day. But in the context of what's gone previously, this is actually, yes, a bullish day. It's maintaining direction, but it is losing its strength. It's tiring. What you're seeing here then is a normal variation day in a cash session. So this is an example using oil. And what I want to show you on this one is a situation where you are seeing a gradual continuation high. And you get essentially a normal variation overnight session followed by a normal variation cash session. There's your initial balance, the boxed area here. We will discuss opening plays, and this is what you would call an open reject reverse initial balance. So we've opened, traded up, traded back, and reversed higher. Open reject reverse initial balance. This is quite typical for a normal variation day. It's a day that doesn't have huge conviction, and that's what's implied by an open of this type. So it lacks huge conviction, which quite quickly eliminates some of the ideas of a more trending type day and implies that you're waiting for more information. That information comes and you get this drive out of the initial balance, pullback, continuation. But the fact that you've had an undecided early move, you've had a minor move out of the initial balance that does move briefly back inside. This is your two-directional trade, and you see it all the way through this move. There's no push and then start trading in a different area, which is synonymous with one-directional trade. It is instead trade one way, roll back, trade up again, roll back, and constantly sort of overlapping previous highs and lows. That's characteristic of two-directional trade. So this, again, does imply that the move can continue the following day, but is once more a day that is not hugely convicted in its move higher. So they're your normal days. You've got a rough understanding of the importance of the initial balance on a day like this. And so to build on the idea of you see the beginning of the day and very quickly you can look at it and say, right, I think I know what's likely to come here. Those two types of days, your normal variation and your normal day, once the initial balance breaks, upside, downside, whichever way it is, you can very quickly assume that the directional bias has been set for the day, i.e. the other side of the initial balance is highly unlikely to break. So you're building up bits of information. You then can start looking for rotational trade for the rest of the day. Any pullbacks can be used to play towards the high of day, any break of high, as long as it sets up a reversal, as long as it doesn't break with huge amounts of volume and energy, massive increases in delta on a break to the upside, for example, then you can quite comfortably say, yep, this is a move that is likely to reverse back. What we're going to move on to now is perhaps what people at least would have in their head as a normal day. However, these are typically referred to, so to not deviate too far from general nomenclature. What we're doing here is following what you would call a neutral day. So, neutral or balanced day would be another way of trying to describe this. These are completely directionless days. Days that the initial balance does not bear a great deal of reference on the day. It doesn't give you any clues as to what the day is likely to be like. It's much more about the moves that the moves that succeed the initial balance. So what comes next, that's going to tell you a lot about how you can expect to trade for the day. These are days that are, to a degree, predictable. And so following the idea of understanding what's gone previous to tell you what's likely the next day, these will follow certain day types quite frequently. The way that you've got to be thinking about a neutral or a balanced day is that these are days where a market is unsure what it wants to do, where everybody is very comfortable with trade in that area. So it shows acceptance. Buyers are just as happy to buy in this zone as sellers are. And so for that reason, you are seeing a day that forms this completely, almost perfect bell curve type scenario. You get a tail, you would be looking for perhaps a slightly bigger tail to the downside. You see breaks of both sides of the initial balance, that's very characteristic. Generally, these aren't massively high volume days, and certainly at the extremes, the energy really does fall out of the market. So you don't see volume increasing at extremes, you see volume that decreases very quickly, and then you get this rollback down the day. So you get this very two-directional trade, constant sort of shifting in both ways. And it does create balance. So the way to think about these types of days is that they don't provide you a great deal of directional bias at all. But what they do provide you with, rather than direction, is implied velocity. I.e., once the move does drive away from these zones, because of that built up energy, that is then released. And as that gets released, that creates directional drive. You can then expect a much more one-directional movement, whichever way you go from here. But the neutral days themselves don't provide you a great deal of clue as to which direction that's going to be. So, how to play a day like this? One of the key bits of playing a day like this is to understand your expectations. Don't have high expectations of movement on a day like this. As soon as you've broken the initial balance up and down, very quickly, you've already been given the information, particularly if these are very weak breaks as well. So your expectations then are going to be for a market that trades two directionally. As a strategy, one of the mistakes that people make is that rather than looking at a trade that is likely to work, they look at where they're more likely to get filled. People often end up, because the market doesn't spend a great deal of time at the extremes, people get themselves stuck trading here because you're always able to trade in the middle of the range because of the fact that that's where almost every single TPO of the day trades, where almost all the volume's done. But the ability on a day that you know is two directional to have any idea as to which direction you're going to go from the middle is very, very limited. And so this is effectively your danger zone. And this is where profiles often get confused in the way people describe them, this is absolutely the easiest place to get filled. And if you're a large time frame participant, this is where you want to trade. Because you know if you want to buy, you're easily going to be able to buy in here. Likewise, if you want to sell. So whilst it is easy to do that, that doesn't mean it is easy to get any kind of directional movement that you can have any degree of certainty in. So you need to have an expectation that you're going to get filled very few times at the extremes, and your aim is to play it back to where it's easy to get filled. You want the ease of getting filled to be about getting out of your trade. So rather than playing from high to low, you want to be playing from high to middle and low to middle. This way, you can be confident that you will be able to get out. And also, you can look at this with the expectation that you're not going to get many opportunities to take trades on. In terms of follow-on from these, as I've already said, the build-up of energy is what's important. Directionally, you get very, very little. The only hint directionally that you get comes from the close and where it is. This close down here is marginally tipping towards the bearish side. The way you want to be looking at it, and what is described as a neutral extreme day, is a day whereby the close on a very balanced day is driven to the extreme, hence neutral extreme day. This does give you a little bit of clue as to next day direction. But that's about the only thing you get. More, what you're looking for next day direction is the movement away from value. That's the bit that you're interested in. The move away from value, as long as it creates an initiative move and you don't get the responsive pushback as you got on the balancing day, that's what you're after. That gives you the clue, that says the move's on, you can play in line with that. But neutral days can quite comfortably follow neutral days. So you can have a completely balanced day that is then completely balanced the next day. Essentially a market that is very comfortable and is awaiting new information. Once the new information comes, then direction can play. Just going to have a look at a couple of examples. What we're going to look at here is the breakaway from balance. And this is really important because this is this building up of energy. These are two neutral days formed one after another. These fall absolutely into the category of completely informationless. Close in the middle, close in the middle. The VPOC, the TPO, point of control, virtually the same prices. Value area within the previous value area, everything about these is balanced. And so this tells you nothing about direction. The only directional information you may have from this is whatever direction preceded. So if we moved up to get to this point, arguably you're still maintaining the upside direction, and so therefore there is a marginal upside bias. But that's not generated by these, it's generated by the prior move. So from this, the only thing you could be taking here is that when you break away from this zone, you can expect a lot of energy to get dissipated out, and you're going to get direction, and quick direction. So this is what they form, and this is what you're looking for these types of days. So we end up with essentially a neutral day within a neutral day within a neutral day. Here you have the first initial balance, breaks to the upside, breaks to the downside. By this point, and this is the key bit on a neutral day, that as soon as you've gone out of the initial balance and failed to stay out, and then gone out of the initial balance the other way, your expectation is this is a neutral day. So there's your first example. Here's your second example. We trade out. This is very two directional anyway. This is on a 15-minute chart. Fall back in, trade out. Your expectations are quite low of any ability for this to stay balanced and for this to drive down. So if you've traded above, you're not expecting this to trade below and keep going. So a play back into mid-range is appropriate. You then get a break beyond the high of the day. Again, doubtful of this move, you can play this back into the middle of range. And the following day, we then get the same again. Same again, small initial balance, break to the downside, break to the upside. By this point, by the time you're back into mid-range, you've already decided, well, it's unlikely to go down. And because you rarely will have a market that trades below the IB and then breaks directionally above, you're already starting to think this is doubtful as well. So we've now got neutral day inside that, neutral day inside that. 3 days of energy being built up, creating a nice big wedge. What you're thinking here, build up of energy. When this breaks, there's going to be decent direction. That's what you're after. So this is what then happens. There's your wedge. The next day, you do get a marginal break, and this fails. That's really important information, because what that has shown you is that with all of this pent-up energy, it can't generate direction on a break, to the upside at least. This immediately tilts your bias to the downside, because the information is sellers aren't giving up on the break. Buyers have tried to get the move going and haven't been able to find enough other buyers to generate that movement. Sellers have not given up, and the next day we open, test higher, and drop, followed by the next day. That's a really significant move. Now, this is a move that does have an element of news to it, and there's a piece of news that comes out in the middle of the day. So the bearish news absolutely would get this market to go down. But the fact of the built up energy, and this is where, as we move into news week, is going to be so much more important. With the build up of energy, the news then has so much more strength to it. The news alone would not justify such a move. But the fact that the news is pushing against a huge amount of pent up energy and a clear indication that we don't have buyers willing to carry this market higher suggests that this is absolutely a market that's got scope to fall. And that's why you go from small 20 tick ranges to then putting in a close on 250 tick range, 10x the previous ranges. So it's the build-up of energy that does the work. I talked about the idea that these days can be expected as well. And where these types of days can be expected, and we'll talk more about these when we look into specific strategies, is areas where, as we talked about with principles, areas of high or low volume. So a market that falls into a low volume zone, remember the idea of a ball falling into a trough and rotating up and down and up and down and up and down. If you think about where that ball would spend more time as it rolls up and down, if you think of a half pipe skateboarding, as it rolls up and down, it spends more time at the bottom than it does any other, because it spends less time at the extremes at the top, because each time it gets less and less close to those extremes, whereas it always comes back to the middle. So, fall into an area of low volume, your expectation is this rotation up and down. As such, unlike use of the wrong word there really, unlike a typical neutral day, where it's hard to define the extremes, despite the fact you are confident that these are extremes that are unlikely to continue, but it's unclear where those extremes are. These types of neutral day are much more definable. You've got an area of high volume up here, you've got an area of high volume down here. So you know that you can start looking for extremes of the day somewhere up here, somewhere down here. You have to give yourself a broad area. It's not about pinpointing. Your job here from a profile is to give yourself an idea of where you think the majority of trade's going to happen. Where do you think the market's going to end up finishing off? What's it going to look like at the end of the day? And if you expect this type of balancing profile, well, this would imply that somewhere down here you're likely to find support, somewhere up here you're likely to find resistance. And as such, you can then look at that, bring your candlestick chart in, start having a look at what you've got down here, and all of a sudden you see there's a really nice clear level. Really nice clear level down here. Where do you find support? Pretty much bang on that level. So what it does is it strengthens already known levels. Because you've fallen into that low volume zone, that becomes a really strong level, at least for today. The high volume equally becomes a strong resistance, and there you go, you get reaction to it. In each of these, you can play back towards the middle of the range. Both of them work. The only trade that doesn't work is this very, very late in the day move out. The very late in the day move to the extreme, you have to think about this, and this is why I was talking about expectations. Do you have the time for this to come back? And that's an important consideration here. With this move in the last hour or two, or even hour, this is more a move that's going to create a neutral extreme day with a close at high than it is a move that is going to do anything else. So this would not be a move that you want to be getting involved in. You want to make sure that you've got the time to play this back. Because if you know that you're in a market that's unlikely to exhibit a lot of volume, then you don't want to be sitting late in the day with the expectation you're going to roll back. Chances are you're not, or chances are you won't have enough time for the market to come back. And you don't want to be sitting in a position going into the next day on the back of a balanced day. Because if you've got a neutral or balanced day here, and you finished a day short here and we open above, this could be a situation where this energy gets released and you're in a lot of trouble. So you don't want to be holding that position overnight. Neutral days, you don't want to be holding the position, because if you hold the position, you don't know which way it's going to break the next day, and either direction is just as likely as the other. Right, neutral extreme day then. This is a move that gives you a chance to say, on the back of what we've previously seen, this probably is going to give me some direction. Excuse me. What we've had here then is a directional move created by some news which shifts value lower. So this is news in the middle of the day, and we're going to talk about this in terms of a double distribution type day in a moment. So news within the day gives you this very strong directional move. We then get a very balanced market. That's not massively surprising. I'll talk more about this when we get onto trending type moves. So you get this nicely balanced day. But what's important about this, and another example of why you don't want to be playing these neutral days very late on into the day, because here you get a move towards the extreme of the day, which creates the close at the extreme. On a neutral day, you will be looking at this as a chance to play short and to play this back down. Now, when that doesn't work out, because you don't have the time left in the day, you don't ever get the chance of that move back. So coming into the next day then, your bias can, in this case, tip to the upside. And you can look for a reversal of that strong move down. Now, the way to be trying to play this, and you've got two ways of looking at it. You can either play this type of move as a reaction from value. We talked about this, movements to value. If you see responsive trade from the top of value, this is suggesting that buyers are willing to move their bids up, essentially. They're willing to pay slightly higher prices. They were at the end of the day, and they're still willing on this day or on the next day. So there's your first potential to try and play from the top of value. Alternatively, having seen that the market does not want to trade inside value and is now trading higher, the break of the neutral day is your alternate way of taking this trade on. So you then look at this area here as your entry. You've got the passive entry, which is about finding a responsive buyer, finding a reversal type setup to play from down here, or you have the aggressive momentum driven break that you play out. And your target can then be to trade through the single prints, as we talked about before, vacuum up there, and then go back to where the move came from, the top of the liquidation candle. So you see these themes starting to build together here now. So make sure that you're very aware of the implication of these types of days. It's an energy build-up, and with those types of extremes, particularly on the back of a directional move, this is important. The neutral extreme day inside a range is not so convincing. The reason being, it could well be a case, as we talked about with ranges previously, that if time on the day has run out and you happen to be trading at the top of the range, this may not be an implication of buyer strength, but more a coincidence of the time of day that you happen to be up there. And that's an important thing to bear in mind. On the back of some kind of directional move, this is essentially saying that people don't fully believe in this and that this is now a scenario that could get reversed back. Right then, trend days. So far we've talked about two directional days. Normal variations, normal days, neutral days, very two directional. You expect trade one way and back, and one way and back. Here, what we're looking at is one directional trade. Now, of course, within this, there will be marginal pullbacks, but on the whole, the general movement on the day is going to be in one direction. That you see initiative followed by a pause, followed by initiative, by a pause, initiative, pause. So very much one side has control. After a bit of direction, the other side has a bit of a response to that, but that doesn't generate any directional pullback. It just creates a kind of stalling or a holding up of the direction that's established. So, characteristics of these types of days. This is a day where the smaller the initial balance, the better. So when you see a small initial balance, you can quite quickly be thinking potentially a trend. It doesn't mean it has to be, because a small initial balance could also lead to a neutral day. But you have the potential for trend. And if you go back to the idea of a normal day, doing all of the range in one with the large initial balance, the small initial balance implies that none of the potential range of the day has been done, or very little. And so therefore it suggests there is more scope of movement on the break. So we have a small initial balance. You could also apply this to an overnight session as well. So you're looking at overnight session to cash session. Small initial balance or overnight session suggests a market that at the moment doesn't have any bias. What you're looking for then is initiative to come in. Initiative drive the market higher, create a set of single prints. That's one of the first early indications. You get this set of single prints, very quickly you're thinking this possibly is a trend day. What's happening is what you call a liquidity hunt. So, other time frame participant needs to buy. What they will do is they will show some initiative, they drive the market up. And by doing that, they'll find sellers. People will respond to that bid up and start to sell. And as they do, that other time frame participant soaks those bids up, which is what creates this bulge of volume. Then you will have the sellers, the responsive sellers give up. So unlike a normal day where the responsive sellers roll the market back down because buyers aren't going to be so keen to keep driving prices, the responsive sellers get out of the way, the initiative buyer drives on again, and you have the same process higher and higher and higher. And this creates a very consistent pattern of initiative, absorb the responsive trade, so that's the trade that comes back, so you will have initiative, absorb the response, so the responsive selling comes in here, absorption, initiative, and again, and initiative, and again, and again. And that's what you're expecting throughout the day. This is your one directional trade. The responsive trade never gains any traction. It just stalls the move, and that's around about it. You will get multiple sets of single prints. The strength is maintained, and you will also very typically end up with the close at the high or very close to the high. So it's not to say it will be the high price, but it will be very, very close to the high of the day. Now, that all sounds very easy. Difficulty is you don't know where the high of the day is going to be. So this has clear implication for the way you're going to approach a move like this. This is an example of what is a tiny trend day in terms of size of movement. At the time, because of it being an extremely low volatility period, was actually a reasonable move. But this is essentially a tiny trend day. This is an S&P trend day that is a trend of 18 handles. Now, when you move into periods of higher volatility, and I showed you an example of this, you had a normal day with an initial balance of 80 handles. So the initial balance on that day was double what is a trend day. And a trend day is typically what you would think of as being some of the larger directional days. Trend days aren't necessarily about the size. Typically, a trend day is a large day, but it's not an essential characteristic. It's about the one directional nature and this constant initiative driving higher of a movement. Typically, this does also coincide with large range. 18 handles at this point in time was bigger than what you were currently seeing. And so that was your indication it is a trend type day. So basic strategies on these. The most important element of a trend recognition is early identification. And the way you have to think about this is that in your early identification, you're not saying this absolutely is a trend day. What you're saying is that this has the hallmarks of being a trend day. And once you have enough information, single prints, small initial balance, absorption, volume being built higher. This is enough information to suggest that this could potentially be a trend day. And by identifying early, what you're doing is you're giving yourself the greatest potential movement. The later you leave it, because the trend day becomes more and more clear the longer and longer the day goes on, the later you leave it, the less you're going to get out of the move. And what also is very difficult with a trend day, because of the way that it moves, because it will move in this kind of stuttered, staggered way, the further it goes, the harder it becomes to bring yourself to buy. Because these types of days are not days that elicit huge amounts of volume and really obvious volatile price action to the upside. Instead, or downside, instead what they will do is it's steady, it's continual. And this, if you don't identify early, the further and further it goes, makes you doubt whether the continuation is really there. And as a result, people aren't so keen to take these types of trades on. And that's a really important thing to recognize. So it's the early identification that's key. In terms of how you play the move, you can play it early entry and hold with the view that essentially your exit is at the close. Whether that is, in this case, 10 handles higher, or in other situations, 100, 200 handles higher. You don't know where it's going to go. Your job is to say, it's highly unlikely that the close will not be near the high, sorry for the double negative, and therefore I can play for that and assume that come the close, we're going to be very close to the extreme of the day. Alternatively, you can use these little absorption blocks and try and play to buy at the bottom and play for the break, buy at the bottom and play for the break, and move it up in stages, sort of stepping higher. The most common thing to see the following day is typically a more balanced type day. People accept the movement higher, and you will get this more sort of neutral balanced type day as participants then use the single prints as support. Buyers on the back of such a large move will then be waiting to try and buy on dips. Typically, the single prints provide you with decent areas of support. Let's go and look at a little bit of trend anatomy, really, because it's easy to spot trend days afterwards. You look at this profile and you see single prints, and you can say to yourself, yep, absolutely, trend day, nice and easy. But what's difficult is in the moment to recognize this. So what are you looking for? Where you're trying to identify the trend is early on. So there's your initial balance, just down here. This is a pretty small initial balance. You look at the previous day, there's your initial balance on that. The day after, there's your initial balance. This is initial balance of about 6 ticks. So much smaller than the previous day's initial balance, much smaller than your average range. It's nice. There's your potential for a trend day. So you're looking for a drive as you come out of there. And you do get consistent green candles on the way up. So after you've seen that, and as you get up to this point here, this is the first instance where you start seeing a little build out of volume. You've got some single prints as well. So you can look at this and say to yourself, in terms of a trade, you can buy here from the bottom of this little consolidation. You can put your stop inside the initial balance, and you do have an unknown target. But with this being a trend day, a fair assumption is that the range could be at least the range of a previous day. Yeah, that's a typical type range. So you could be looking to be long here, with a stop here of about 6 or 7 ticks, and the potential of taking a winner of around about 40 ticks. But you don't know whether that winner could be 40, 60, 80, could be many more. As the day goes on then, you get another area of low volume consolidation, another area, and you can see within this that you're not seeing this constant drive. It's periods of sideways trade, and this is the period where responsive action comes in, the market slows down, and then you get the drive up. The hard bit about the drive part is the fact that the buyers, or the person buying, the initiative buyer, creating this one directional trade, you don't know when they're going to decide that they can no longer get filled. Because that's what's happening. When they realize no one's selling to them, they will drive the price up. So when that happens, that's when it will move. That's a very hard thing to define. And for that reason, strategy-wise, you need to be more looking to try and get in at the bottom of the consolidations than you do to try and play the break. Often you will miss the break. Also, often the break move is reasonably small before it falls back into another consolidation. Another example, this one's in the pound against the dollar. Typical type move, direction, you see absorption happening in here. So you can often see delta actually falling in these zones, because what's happened is sellers are coming in, selling to a buyer who just keeps putting their bids there. When they stop getting filled, they will then drive the action higher, as you see there. And you see the same pattern occurs again, and up, same pattern again, and continuation. This is a 5-minute chart of an entire day in the pound. So just so you've got an understanding of what you're looking at. So the little profiles that I've drawn are the building up of the volume in each of these little absorption zones down here, then here, and then you start to get a more wider or less obvious stepping part of the profile as the day goes on. That's very typical. So in terms of trade strategy, you're looking to try and get in these zones, establish where that range is bottoming, look at where you've got low volume support, look at where you've got absorption coming in on your ladder, and we'll talk more about this when we do order flow. That's where you can play from, and be patient. But unlike a neutral or a normal day, you're not looking to get out on a break of the high. You're looking to hold and wait for the pattern to come again. You can even add and add and add throughout these types of moves. This is perhaps your textbook trend day in terms of every aspect of this works. What I mean by this is that, one, you have the absorption phases and you have these little pockets of low volume, single prints all the way up. But you also, and this is very typical of trend, we'll see even on a minor scale that when resistance is broken, it becomes support, or at least it does not break back. You may not even come back to it, but it doesn't break back. So if you look at where all the blue arrows are, and the red arrows being each of the little resistances, each time the resistance breaks, it does not come back, or it doesn't break back. So you don't get any of these blue arrows, the market trade back below them. That's very, very typical of a trend type day. But this could be identified very early on. This is your overnight move, if you will, in the pound, pre-European session. You then have the drive higher and pull back. The pullback then starts to build volume. So even if you don't get in on the very first part, once you break this high, that's the point where you can think, yep, the move is on. By this point, you're trading here above the previous day's high, which is down here, around about 50, you're trading 26 above there. Once you break, this is the point where you've got a pretty solid idea that this could well be a trend. By this point, you've got low volume, high volume. The break creates the next leg of low volume. You can then look to play it passively from here, or you play the break. But if you play the break, accept that you may well, if you've got in here, see yourself back at a scratch over here. Same again, there. Not quite here. If you play the break, you'll nearly come back to a scratch. You'll give up the majority of your trade. And so you have to accept that by playing the breaks, you will typically see the market come almost all the way back to you. And that's something else that's quite off-putting in a trend type move. The other thing that is useful for spotting trend type days is small overnight sessions. Now, I gave you an example of a extremely low volatile S&P trend day, 18 handles. This is a situation where you have a small overnight range. Now, the overnight range in this instance is in fact 50 handles. So you've got this small overnight range. You've actually had a small previous day's range as well, cash session, of around 50 handles as well. So that's giving you a reasonably tight range-bound market. This is building energy, remember. You then get a very small initial balance. So cash session open, 10 handle initial balance in the S&P. So that's small. Certainly by comparison to the overnight range, it's only 20% of that. And then you get the directional move. And this directional move gives you a full 130 handle move in the S&P. Very directional, single prints all the way down, close near the low of the day. Close actually is 18 handles off the low. But on the back of a 130 plus tick move, or 130 handled move, that's an acceptable give back, because if you don't, if you try and get out towards the low, you don't know that last 5-10 minutes could not have done another 10, 15, 20 handles to the downside. So you have to be willing to give something up and accept that the close is your indication of your exit rather than a price specifically. In terms of playing this trade, because you've already got direction early on, the first set of single prints can be played like a kind of flag break or break of low. That creates your first set of single prints, that creates your passive entry there, and then continuation type movement. Okay, this is perhaps more what people think a trend day is. And this is a P or B liquidation day. The reason for that, or the reason for calling it a P or B liquidation day, is because of the shape of the profile, this being a B-shaped profile. What is very important about these, in identification of them, is that the open and the initial balance will form the extreme of the tail. So if you're looking at a B, the open has to be up here. If you're looking at a P, the open has to be down here. It does not work, or it is not, doesn't imply the same thing if you open here, balance, and then trade down here. That does not imply the same thing, and it is a completely different implication for the next day. What these types of days are showing you is liquidation of positions. So this is medium time frame participation taking control. You will get very one directional, very fast, large movement. So it's almost like a large IB normal day. Apart from the fact that the drive that you get in the liquidation does not generate this two-directional trade. Instead, it moves the market and then people reassess from there. Hence why you will generally get this long string of singles, but only typically one set of single prints. Unlike a trend as well, it will not be a day that moves, stalls, moves, stalls. It will do the entire move in one typically, or in one kind of directional move, and then you go to two directional trades. So it's almost a 2 days within one. A very large directional move followed by a balanced day. Often these types of moves can be predictable as counter-directional moves. So where you have a market that perhaps trends down and starts to balance, after it balances, you can have a liquidation back in the other direction. Because what's happened is you accumulate sellers on the move down, the sellers don't get the continuation, and then they liquidate as the market bounces back. And that creates this quick move up, which is what gets them out of trade. The other identifier of these, or typical identifier, is that the initiation of the liquidation move, i.e. that fast move, will typically come on a break of a reasonably obvious reference. So think the top of a small range. As that breaks, liquidation happens, people get forced out, fast move. And that's the tail on your B or your P, depending on direction, followed then by this two-directional trade. So, you get the liquidation. Now, you don't see new initiative because, and this is important to remember, liquidation is people exiting positions. Once they've exited, nobody's going to keep the move going. And so if no one's going to keep the move going, why, if you were, in this instance, somebody wanting to sell here and have now had that taken away from you, are you willing to sell here? Because the people that have moved the price down are not people who are likely to continue selling. Once they've got out of their position, once they've sold, they don't want to do anything else. They've taken their loss or they've taken their profit, their trailing profit, and that is it. The job is done. They're out of their position. Now we're waiting for new information or new participation to come in. As such, after you get this type of movement, you are then going to get this two-directional trade, forming essentially a neutral day, which is the body of your P or your B. To use correct terminology, if you will, a P shape, i.e. open and drive up, is a short covering move, so shorts covering their positions, and a B shape, open here, move down, is a long liquidation. In either event, I think an easy way to think about these is that the positions are liquidated. That's the important thing. People are getting out of positions, and it's the nature of that which differs from a more initiative entry type move, which is a trend. Trend moves, people are getting into position. Liquidation moves, people are getting out of position. So, basic strategy. This is about breakout trade, and it's about recognizing that if you are moving into a scenario where a day like this is likely, that trade needs to be taken aggressively. You need to be looking for momentum, and you need to expect that this is not going to keep going. This is going to be a move that charges, and once it's done that, and you start to see it become two-directional, that's the end of the move. And at that point, you then move into the second phase and your second strategy. Once that drive up has come, you can almost view this move, so the drive part here, as the large initial balance on a normal variation day. And so then it's about playing reversal, reversal, and that becomes your strategy for the rest of the day. Often you can use the single prints formed as your base for that rotation, so it makes it a little bit easier than a normal day to actually play that move, because you get an early reference point to play from. Because it's a liquidation, it doesn't give a strong directional bias. Yes, in this instance, value has been moved lower, but the only reason it's moved lower is because people have sold, and now you're seeing people who still need to sell will sell on a bounce. They'll try and not take the worst prices, and buyers are going to be thinking, right, well, why would you buy back up? You might as well let people come and sell to you. So you get this balance, but it means that this move here doesn't have any support, any resistance in it in this instance. Who, after selling to get out of their position, because they were long, is now going to sell on the bounce? They're not. And for that reason, this provides very, very little resistance. So movement into here, it's a very easy reversal. Prime example, what you've got here is a sell-off move, and this is in fact a liquidation down, followed then by 3 days of essentially balanced trade. But what's important about this, and what gives a clue to the liquidation, close, close, close. What this is showing you is a market that cannot maintain direction down. As such, people who are short in here, from a medium time frame perspective, people who are willing to hold on to this for a few days looking for the continuation move, aren't going to be out because you're not breaking away from this range, but they are constantly put under pressure. As such, once you start to get the break to the upside, when you get the drive out of the initial balance just here, this high just here, you get this quick drive up. And as you get this fast drive up, there's your liquidation move. It creates the typical single print. You do get a marginal consolidation, but the whole move here is very, very straight line. And after that, you then move to this two-directional trade. Pull back onto the single print, which is also the previous high. You do go and break the high of the day up here, and this gives you an opportunity to buy down here. You can play this for the break of the high. Reason being, you can have liquidation-looking moves that do turn into trend-like moves, and that's what you're looking to try and play here. So that's the important bit. But on the whole, once this move has happened, and you could play for this because you can see where this could come from, the initial balance break, the break of the previous high, that's where your liquidation is coming from. Soon as you see this spike of volume, drive of delta that comes in here, so bear in mind, it's not yet broken the high, you could buy it into the high, play for the breakout. You play that, you're on this move up, and as soon as that starts to stall and become two-directional, and to be fair, it does here, so parts of the position are covered. This is actually one from one of my debriefs. So in this case, this is slightly late on the break, but buying 2 clips and then another clip at 93. So 3 clips in, covered one, and then covered another up here, and then held one for the continuation of that movement. And so that's the way that I go about trying to play this. You're trying to play for the momentum. This is a late entry there. Entry could definitely be improved by using the delta to get in on the break of the high rather than waiting for the confirmation of the break of this high. So that's your breakaway. What I also want to show you is the uncertainty that a P or a B-shaped day creates. Because the problem with P or B-shaped days, as I say, they don't indicate continuation necessarily. And so you can have a situation where participants try to react to one, fail on that move continuing, and then get liquidated themselves back in the other direction. This is particularly common in a market that doesn't have a great deal of directional bias and is a market that is perhaps more ruled by short and medium time frame participants than other time frame participants. So what we have here then is 4 days of grinding higher. We get 1 day down that closes in the middle of the range, so pretty balanced day. And you then get a gap up. Now, this would suggest that the move continues. Trade up, trade down, no continuation, we go higher. But all the buyers then, who have been buying on these days and not got stopped out because we don't really break the low, or we trade to the low, the buyers who bought the dip here, then they get driven out because on the gap up, when they don't get the continuation up, they're forced out. And this creates the liquidation down and then B shape. So there's your quick move down, consolidation. On the back of that, you then entice sellers in. And this is going to be short-term reactive sellers. People seeing the sell-off and thinking, yep, we can sell this. So we open gap down again. But when the sellers don't get their continuation, you then get a liquidation of sellers back up. P-shaped day. But the only reason we're back up here is because sellers in here haven't got the move down and they have then bought theirs bought back. So this doesn't mean that we should be going higher. And as such, you come in the next day, we start to trade lower, and all of the buyers who were buying it in this zone down here, once you fall back inside, get forced out and you get liquidation again. This is a classic example of a market that is low on confidence and is ruled by short time frame participants. To give you a bit of wider context, this is where you were. We're in a rather bullish market overall, and a bullish market that has exhibited 2 or 3 weeks of sideways range. So people aren't really sure now. The bullishness has been taken away from it, but ultimately it's not exactly bearish. And this is where you get this sort of two-directional pull that people don't want to go one way and they don't want to go the other way. And this is where you get the B, the P, and then the B again, before you then get a more controlled move towards the downside as people start to step in once you've moved away from this 2-week range. And to bring it onto a full session 15-minute chart, this is what you're getting. So here are the different phases of it. The overnight bid up, no continuation, liquidation move and balance. The overnight drop, no continuation, liquidation move and balance. Sideways overnight move, and it's only once you start to fall back into this range where you then get the next liquidation, which is a little bit more, and you look at the difference in these moves. This one, straight down, big red candles. This one, straight up, big green candles. This one, much steadier movement. This is a more controlled move and a more sustainable move compared to the other two. And it's for this reason that you can then, and this is about building that story up, looking at the way the market trades. These two are complete one-directional liquidation moves. This, you can see from the candlesticks, has got more wicks in it. It's two-directional, but it's still got more, it's battling its way down. This is a much more sustainable move than these where people are just giving up and running for the exits. Now, the reason that I was saying about with a P shape or B shape, so a liquidation day, being willing to try and play in the same direction for the continuation is that they are potentially going to turn into a trend day. It's not that common, but even if it's not a trend, you may get one more leg of the move as people get forced out. For example, take here, you have people short, they get forced out. Now, the first people give up. The people, imagine you're short, you're then going to be looking to try and buy to get out. So not take your biggest loss, but try and buy on a pullback to take a smaller loss. If you don't get that chance and it breaks the high, you could then get forced to play once more. or to, you get forced out once more. And this is why when you get this type of scenario, where again you're getting closes towards highs, which is indicating that anybody who is selling up here is struggling to get the results they're wanting, that when you get that and you get the break, there's an element of trend about this anyway, that you get this high volume and then higher volume up here. So you're seeing this stepping of volume, which is more trend than P-shape. You're looking at the beginning of the day thinking, that could be a trend, could be a liquidation there as well. And so at this point, your view is, right, you can buy on a pullback down here towards the low volume, high volume zone here. So we move on. That's your early thought. And it's about deduction. And when you understand the different day types, you can say to yourself, well, based on the small initial balance, based on the break of highs, this isn't likely to be a normal day. It's not likely to be a normal variation day. The single prints and moving a volume higher suggests it's not a neutral day. So this could be a trend or a liquidation day, one or the other. So now the job is to work out which one it is. If you buy towards that pullback, where the low volume is, the single prints, then you're in this area here. This looks like a liquidation day. And so you can say, so okay, liquidation day, that's fine. I can try and play on a pullback towards the high. So you can buy it somewhere down here, buy it on a pullback towards the high. And this is why you wait, and you could be willing to at least try and play for the break of the high. Because here you get the drive through the high. Bang, straight through the high. Lots more volume comes in on the break, straight up, another area of low volume, and balance higher. So it's a kind of double P-shaped day. And that's why you can try and play for that next leg move towards the upside. Another example, and this is one where the liquidation gets you to a point where the market could reasonably stop, but if that next level breaks, and the next level being this sort of this little box just in here, this little box being the previous low, bottom of value, VPOC, previous high, multiple reference points. If that breaks, that's where you could get the next leg down. And so what we've had here then is liquidation up, which immediately makes this area doubtful. We fall into this area late in the day, which now has set the tone for the potential move down. And then you get the open, test into range, no trade into range, or no holding inside of range, liquidation down through the single prints. And then at this point, quite reasonable to say to yourself, okay, we're going to see this balance out. There's your B-shaped profile, job's done. And this is where, if you can play the pullback up here, use those single prints, you can play for the next leg. And if it goes to here, if it goes down into this little box and trades down there and rolls back up, so it just trades down here and bounces, you give it up. And you say, okay, that's the job done. There's your false break. Now I can try and play back up to here, and we can repeat the process and try and play for that type of movement. But by playing for that next leg, you open yourself up to the possibility of this drive down, which is what then gives you that final leg. So variation on a P-shaped day. So you call it a P-shaped variation, if you will. Right, final of the common day types is a double distribution day. Now, what this is all about is new initiative in the middle of the day. So rather than this being a news-driven initiative early on in the day from news in an overnight session, rather than this being a strongly directional move that comes in throughout the day, or even a liquidation, what this is more is a situation where you have a market that is comfortable or accepting of value where it is, and then gets new information, either in the form of news or in terms of a technical trade. And that technical trade would be that the current balance gets beyond a certain point and then tips over, so sort of falls off the cliff, if you will. Typically, you're going to see a pretty stable start to your day. This could be a day that starts off looking like a normal variation day, a neutral day, a day that really isn't offering a great deal. After that, you will then get some kind of new initiative. This generates single prints, this generates one directional trade, and then you move to accept value somewhere else. So essentially, you're trading 2 days in one. You trade a normal variation day or a neutral day, followed by a normal to normal variation day. Again, 2 in 1, value establishes one area, value establishes lower, a capital B if you want to try and think of it as different letters. So what happens as well, and what's important, is establishing value early in a very balanced way makes trend difficult. The more and more volume you put in a certain area, if you think of what a trend day implies, is a narrow profile. It's hard to create a narrow profile when you've got so much volume here. So that's the first thing. You then need this drive, and this would either come from news or a technical sweep of value. I'll give you an example of this. The thing you're then looking for, so in this instance, there's your balance lower, is then you're looking at where the close is. Like a neutral day, the close relative to the extreme is important. So you're judging it on whether it closes near the single prince or whether it closes near the extreme of the day. That gives you an indication as to the next day's direction. Is it a day that's going to trade back into the single prince, or is it a continuation day? So with the strategy on this, if this is a news-based one, there's an element of predictability that if you have a very balanced day, you could say, right, I know there's news coming out in the middle of today, and therefore this potentially could lead to a double distribution day. So your focus can be on the initiative move, trading the news. If it's a technical one, again, this is to a degree predictable. If you have a situation where you have a very balanced zone and you're trading above it, as you fall into it, as we've talked about with high volume zones, you can sweep across that. And it's the sweep across that creates that low volume. And that's where you could imagine a double distribution day. So in both instances, it's about trying to play for that momentum, that fast directional move, very similar to a liquidation type day. You're trying to work out where that could happen, why it would happen, and then play for that. Next day then, the information that you're going to gain is whether this is a strong or weak double distribution. A strong double distribution is one where the close is at the extreme, so it doesn't relate to direction. A weak double distribution is where the close is close to the single prince. So here you've actually got a kind of neutral double distribution, which would suggest that you're perhaps looking for a more balanced day afterwards. So what we've got here then is a weak double distribution. This is a gold example. You get the higher distribution, which is this range here, the little blue box, drive lower, lower distribution. So there's your initiative move in the middle. That's created by a bit of news. That drives gold lower, or break of level, whichever it is. It doesn't matter which. It's about the acceptance of that information. And the acceptance is not great because the close is here towards the top of this range. So it's accepting trade down there, but it's suggesting that people aren't comfortable to put the close to the low, which would imply that the strength has been carried and maintained throughout the whole session. As such, you can then look for a move back into the middle of the double distribution day and a fill-in day. So you can then, once you're inside this blue box, the low volume zone in the double distribution, you can trade through. And when you reach the top, you can trade back down and back up. And this is your classic example, like I was talking about before, of a neutral day forming inside of what I would call a cave. So you get the formation inside the cave, two directional trade up and down throughout the rest of the day. The temptation here on the back of this sell-off is to see this flag. And this is where people trading just simply on a candlestick basis are going to see a flag here and think that moved down. And it's those people who are trapped in here that cause the liquidation up because they're not taking the appreciation of where the close is on that weak double distribution. This is a simple example of the fill-in type double distribution. So you have this double distribution profile here, two different distributions, which sweeps a tight range. So this is a very low volatility market again here. Sweep a tight range, double distribution, and then you put the tight range back. So this is your double distribution day where you trade down, up, and then you trade entirely inside the range of this day. Classic, simple double distribution, fill in on the back of a weak close. And the other factor is that if you open inside the double distribution, you're very much expecting this two directional trade within that zone. And finally, a strong double distribution. This is one, again, this is a news generated double distribution, one where you have a day that starts off trading towards the top of the range. In fact, it does have a small element of trend to it, just up here that we trade here and then trade slightly lower. At that point though, the bit that would make me think it's not a trend is the fact that this is very small, drive out, and then that's almost entirely reversed. That's not synonymous with a trend. A trend would typically put in drive sideways, whereas this has it sort of creates volatility and a two-directional trade in here, which is much more wide in its range than one would expect for a trend type move. And then you get the news, which drives lower, and then the consolidation into the end of the day. That pulls value down, close towards the extreme. Yes, it does close below value. So what's important to work out here the next day is with the open that is gap down, can you get inside range and can you get inside value? The first move gets you back to the bottom of range. When you don't get inside or when you fall away, more to the point, so you fall back out of range, then you can look for the continuation to the downside. So there are different types of double distribution day. They're perhaps some of the least common days that you're going to see, but they are predictable. You know when these are potentially going to happen. Sweeps of ranges or news, that's the bit that you know. So it's about having that ability to say, I can see where this could happen, and then you're waiting for the hallmarks of that increase in velocity, increase of energy, increase of volume that drives you through those areas. And if you don't see it, well, you can assume that you're going to maintain that current balance, which is typical of the first part of a double distribution, and so is essentially running into a neutral or normal variation day. Right. Final example of a double distribution, and this is about the thought process that goes into the double distribution beginning. So what we're seeing here is balance day to start with, CPI news, so news generated double distribution, breakout to the upside, single print. So at this point, with the break of a previous couple of value areas, you could be looking at this thinking double distribution is on. And this is the element of being able to predict these things and see it in real time. So at this point, you can look at this and think, right, we've got some low volume there. We've had the drive up, great. This potentially could be where the double distribution forms. So it's about imagining the end of the day. And so you can look at this early on and say, right, well, that's going to be likely the area to try and trade up from there. Leave the single print, leave these previous highs behind, balance. The reason we're showing this is that you have to look at it and say, this is what I think is going to happen, and then accept the reality that the rest of the day, it does proceed a little bit higher. And this is the double distribution day. But rather than holding 30s, which is where initially it looked like it could, trade actually comes all the way down back to these previous highs. And that's where we finish on the day. So it creates a very messy double distribution day, and one that doesn't really look like double distribution. But in seeing it created, you understand the implications of how it is similar to a double distribution in the nature of trade, yet it doesn't look like a double distribution. This is what's so important about building the story as you go along. This 100% looked like it could have been a double distribution and then fails to do it. That's important information. The next day then, this area retains importance. It's a previous high, another high, it's the pullback high. This is an important area around about 19. The next day, on the back of, you could call it a very weak double distribution, gap down, trade into range, bounce back up, and stop at that high again. This is clearly a very, very important area. And when that breaks, you then get the trend move next day, which essentially does the job of the initial double distribution idea, which is here, and then puts the full trend in for the continuation higher. It's about building that picture up and sort of seeing what it could be in the moment, and then taking what it could be for what it is and asking yourself, what does that now tell me? Final thing then, quick summary of each of the different types. And I can send this over in a kind of summary cheat sheet. What I've got here is a normal and a normal variation day. In each of them, the initial balance, so I'm going to use examples where we go up. The initial balance creates the low of the day, and this is larger on a normal day. After that, both essentially do the same thing, and the red lines are your value areas. After the initial balance, so the orange trade, normal day, you will get limited extension of the initial balance here, and two directional trade, with trade well back inside the initial balance. Normal variation day, you will not. You will generally use the initial balance as your support and trade above it. So shifting value higher outside of the initial balance. Both of these you would expect to maintain a bullish bias, but bear in mind the context in which they've been formed. Is this breaking away from a range, starting something new, or is this finishing a current move, a tiring out of a current move? On the whole, you would also expect a wider, more volatile value area on a normal day compared to a normal variation. As I say, directionally, both of these you would be looking for continuation. Neutral days. Typically, you're going to get an open auction type of initial balance, so a market that is non-directional to start with. So you get this non-directional early trade. Point 2 and point 3 are the most important. Point 2, you're expecting a weak breakout. Low volume, no continuation, no ability to find resistance when you come back to the initial balance. Once that has happened, and you're inside the initial balance again, the clues are all there. By point 3, if you see the same type of action as point 2, you can be very confident that this is a neutral day, and you can then expect for the rest of the day this same type of two-directional trade. This does not give you a great deal of directional indication. It does give you a completely balanced looking profile, a very sort of perfect bell curve, if you will. And the next day, the close is the only clue. But you can expect the next day or the break away from this zone to be a bit more explosive because of the pent up energy. Close in the middle, sideways, close at the extremes, directional. Trend days then. Small initial balances to start with. You will not often, it's very, very rare to get a trend day that starts with a big initial balance. This would imply that you have significant news which then creates trend after that. That has to be very, very important game-changing news to create that type of situation. So you have a small initial balance. You get the drive out and then absorption phase, followed by a repeat of this pattern. Next drive, absorption again. Next drive, absorption again. You can, and this is an important thing to remember, lunch times you can fall into a bit more of a wide consolidation. This is simply because more people are taking a break. And as people go and take a break, you get this wider consolidation, followed then by the same format. Close, typically at the high. Next day, typically a neutral day, as people accept value now in these new areas, and usually single prints will act as support. So you can continue to play in the direction, but with the expectation that this is going to be a more muted follow-on day. Liquidation days, generally a smallish initial balance inside of a well-established current range. And it's about breaking away from a certain point which creates the liquidation move. Once that happens, you get this straight line move, followed then by essentially a neutral day. Single prints get formed, and these can be used as your support. So if you imagine a normal variation day uses the IB as support, the single prints generally provide you support on a P-shaped day or B-shaped day. After that though, so looking for your drive and balance, you can then assume either direction next day. The shift higher in value allows new buyers to come in and keep the move going, but the shaky foundations that this is built on, liquidation, does not provide a great deal of support if you start to fall back. If you start to fall back, full reversal is very much there. Finally, a double distribution day. These are days where early on, there's not a great deal of new information, and you could trade this like any normal day, a neutral day, a normal variation day. You will then get initiative generated by news, generated by a sweep of previous range, a technical breakout, any of these things that could give you that sudden directional move, and then acceptance at a higher price. So essentially, you could have a normal variation day here, followed by a normal variation day here, and the low volume in the middle becomes your kind of difference, and that's the bit that maintains that move towards the upside. You can then use the single prints for the rest of the day as your support to balance this out. And like a neutral day, the importance comes on where the close is for direction, but also where the open is. If you open inside the single prints, you can expect a balanced type move. If you open above, even if you've got a weak close, you can still look for the single prints to be supportive. And it's only once you fall into them that really the weak double distribution actually shows its face as a reversal type pattern. So there you have it. Quick summary of the main different day types. Provides a framework to judge each day by. Now remember, not every day is going to complete and look like an absolute hallmark characteristic day, a perfect double distribution, a perfect P-shaped trend day, whatever it is. But you're looking at the characteristics of them that matter. That's the bit that you're interested in. Do they have the characteristics? Because if they have the characteristics, even though they may not look perfect, what's happened on that day still will suggest the same things for future days and for the general story that you're creating. Right, we'll move on and we will look at open types and how to start playing these days from the beginning, where your early trades come from.